All right, folks. Well, thank you for joining me here today. We're going to have a little class. We're going to go over levels. Very important, especially in this market. We're going to go over support, resistance, supply and demand, liquidity. What's the difference between all those types of levels, how to find them, and how to use them to execute trades. So if you're not familiar, the most common type of, levels in the market are support and resistance. So that's where we're going to start. What is support? What is resistance? In short, support is a specific price level in which traders are looking to enter longs, or shorts are looking to cover their short positions. Resistance is a level where longs are looking to exit their longs, or shorts are looking to enter their shorts. So support is a specific price level that traders are watching because maybe at some point in the past, the price has shown that it likes that area for a reversal when it's on a downtrend, and resistance is a level that traders watch to short because at some point in the past, it has shown that it's a level that is going to create a reversal to the downside. Now, obviously, these levels can be broken. So a support can be broken to the downside, and a resistance can be broken to the upside. After it's broken, they switch. After you break over a resistance, that becomes a support, and after you break under a support, it becomes a resistance. The main rule to finding a support or resistance is looking at a specific price point in which the price has touched at least 3 times and is unable to break. Now, let's look at SPX, for example. We're going to go down to the 15-minute chart. Let's find a resistance level for SPX. Well, remember the rules. We have to find a specific price in which we touched more than at least 3 times, but were unable to break. It's easy right now to find one, as that level is 4,300 or 4299.5, just 4,300. As you can see here in the chart, we attempted to break this 4,300 level several times, at least 3 times, 1, 2, 3, but were unable to do so until the 4th time. This shows us that this is a strong resistance. It's a resistance. We can mark it as a resistance. The moment we broke over it, it became a support. Okay, so that is how you find a resistance. You look at an area where the price has touched 3 times, but it's unable to break. Support, same things. Let's look for an area or a specific price in which SPX came down, touched it 3 times at least, and was unable to hold under it. If we look, we can see that after moving up, we came down and we touched 42.69, right? Price moved up, we came down again and touched that exact 42.69 level. And then for a 3rd time, we came up, moved down, and bounced or sort of consolidated at that level. So this shows us that 42.69 is a support for SPX, okay? This is a support. Now, in between these two, you can find other support and resistance zones, but these are the 2 very clear ones. You see, everyone sees it. Price comes down for the 1st time, bounces there. 2nd time, bounces. 3rd time, bounces. Now, if you look closely, this level has something in common on each touch, and that is that the price does not close below it. It touches it, it bounces, it may even go below it for a little bit, but it does not close on the 15-minute chart below it. So that tells me that this level is important. And then the moment it did close below it, guess what? We moved lower. So you can see right there, and even right here, right? We had that move, which almost 10 points to the downside. To the upside, you can see that this resistance, although we did close over it 2 times before we finally broke it, each time it was immediately, that momentum was immediately killed by the next candle, which closed below it. So again, it shows us that this is a resistance, 4,300. Now, a thing about support and resistance levels is that they tend to be at rounded even prices. 4,300, 4,250, 4,280, those even numbers are usually where support and resistance gets created, simply because they're easy numbers for traders to remember, and the algorithms also like those even numbers, as it makes it a lot easier for them to execute trades. Now, the thing about these levels are, you cannot just trust support and resistance simply because there are other things at play, okay, that will validate a breakout or a breakdown. But let's say that you were just using support and resistance and you wanted to trade with just your support and resistance levels. How would you go about that? There are three things that must be checked off in order for you to enter a trade when a level is broken. The first one is the trend. So if you want to enter calls at the break of a resistance, the trend must be to the upside. Overall trend must be bullish if you want to enter longs at the break of a resistance. If the trend is bearish, you cannot fully trust the break of a resistance simply because it could just be a fake out. So if you want to enter longs at the break of a resistance, the trend must be bearish. Bullish. The second thing is you must get a retest. Now, sometimes you may enter without a retest, but that just lowers the probability of the trade being profitable. If you want a good profitable trade that involves a break of a level, you have to get a retest, because that retest is what is used by traders that didn't get in at that first break to re-enter, and it just kind of validates the move. So if you want to enter longs at the break of a resistance, you have to have a bullish trend and get a retest. The third thing is you want to make sure that there is a bullish structure that helps traders kind of visualize if the market has potential to move up, which means as you break that resistance level, you want to zoom out, look at the chart, and look for some sort of bullish pattern, like a cup and handle, a descending wedge, a pennant, a bull flag, anything that kind of helps traders decide whether they want to enter longs or not. So far we have bullish trend, retest, and a bullish structure. Let's look at SPX right here. All right, so we broke resistance, right? The first thing we have to look at now is the trend. What is the overall trend? Clearly, we're moving higher, as you can see. The trend is to the upside, okay? Bullish trend. Second thing is a retest. When you broke out like with these initial candles, did we get a retest? No. So we want to enter longs here when we get the retest. Of course, if we get the retest, which in this case, we did, right? Price moved back down, right? So as the price came down, we had to look for the third thing, a bullish structure before the break of the resistance. What did we have here? Well, if you go into the hourly chart, because you have to look at many time frames, we had you see what could be a channel, a trend that was keeping the price down, that was broken. And furthermore, we had a cup and handle. So now you have a bullish structure before the break, you have a retest, and you have a bullish, what's it called? I'm sorry, a little mind fog here. You have a bullish trend. So as we get this retest right here, what do? Well, you look for longs. And obviously that would have played out as the price came down to 42.91, and then it boom, it just rallied back up to 43.11. To the downside, you want to look for the same thing. Where do we have support? Okay, we have support right here. Perfect. So if the price breaks, when it did right here, did we get a retest? No. So we have to wait for the retest. No retest. And also, if you look at the overall trend, is bullish. So right here, you have a bullish trend, no retest, price comes back up, right? Comes back up, okay. You're thinking, well, maybe this is my opportunity to short. Sure. Now we have to look at the overall structure that was formed before that break. Does this look bearish? Yes, it does. You have a double top. So in this case, what you're seeing is 2 out of 3 things checked, right? You got your retest, you have a bearish structure, but the trend is not in your favor. So this is not a breakdown trade you want to take because it's not a breakdown. It's just a retest of a low before a move higher. Everyone keeping up so far? Yes? No? Okay. Well, let's look at an example of a real breakdown. Right here. You see how the price obviously finds support right there. Right? There's support. Beautiful. Okay. What's the overall trend right there? It's still bullish. The trend has always been bullish. But let's say that you decide to just focus on the short-term trend or whatever. You're not going to see many breakdowns. And let me tell you something. As a trader that has been trading for a very long time, you never want to counter trade the trend. When you have a bullish trend in the overall market, you want to focus on long setups. That's it. Imagine how much money you could have made had you just focused on long setups over the last 6 months. Just long setups, right? But if you ignore the trend right here, you see the typical breakdown, right? What did we have? Well, breakdown, retest, right? You see how we came exactly back to that support point, retest, and right before the breakdown, what's this right here? Well, obviously you have a double top, and from the looks of it, this could be, could be a head and shoulders. If you really put the right shoulder up, you have a dislocated shoulder. But from what it looks like, this could be a double top. You also have a gap. Gaps are very important, but that's for another class. So you could have taken this short right there at the retest because you got the breakdown of support, your retest, and you had a bearish formation before the breakdown. So you see, price moves down, it comes back into support, and it, booms again. Here's another example of a bullish trade. Obviously, we can see right here that the price finds this area as resistance, right? Everybody agrees with that? Resistance? Perfect. What's the trend? Bullish. Bullish trend, right? What's the structure? Bullish. Did we get a retest? No, but obviously because the structure is overall bullish, you could have taken it. But you also had this level here, and this actually followed that, as you can see. Breakout, retest, 2 out of 3, bullish trend. Take the trade. See? Breakout, retest, bullish trend, longs. Price just rallies after that. So that's support and resistance. And that is how you use support and resistance to identify a potential trade. Okay. Now, support and resistance are more effective on the lower time frames. 15-minute, hourly, 5-minute, 3-minute, 1 minute, whatever it is. Support and resistance is most effective on any time frame below the hour. As you go up over the hourly, it becomes less significant, and that I guess that role of support and resistance gets passed on to our next topic, supply and demand. So you go up in your time frames over the hourly, you want to focus solely on supply and demand. Areas where there's going to be that imbalance in price between one side and the other. Now, what is supply and demand? Supply and demand are ranges in which institutions, mainly institutions, have very large orders scattered across various prices. Why? Well, because if you're an institution and you're trying to buy 100 million shares, just an example, you don't want to place that order at a single price. That's going to have an effect on your fill. If you want to get the most effective fill on your order, you want to place your orders across many different prices. Let's say 2,250, 2,245, 2,240, and that creates this range where the price is going to have a lot of support. Now, the thing about supply and demand is what we call distribution and accumulation and distribution. So accumulation and distribution is it's basically where the market goes sideways and the institutions decide whether they want to accumulate because they see a potential pop in the price that's coming, or they want to distribute, all their holdings onto somebody else to hold the bag. So if they think the price is going to go down, they're going to slowly sell out of their position, mainly, sell it to retail for them to hold the bag because they expect the price to move down. So supply and demand are created when that is in, that's in play, when the institutions are either accumulating or distributing, meaning getting out of their positions because they see the price moving down. So how do you identify an area of demand and an area of supply? The key is consolidation. Consolidation. That is the key. Let's take a look here at SPX, right? Where do we see an area of high consolidation? Right here, right? Between 4281, 4271. You see, this is an area where the price liked to consolidate. So this right here is where we have demand, right? Around this range. This is demand. Why? Again, look at the consolidation. When it's in this range, you have that accumulation distribution, playing out. If we look to the upside, where does the price kind of like to consolidate? Around this range, right? Right here. So this is our supply. So what's happening here is simple. They're using this area to accumulate, and they're using this area to unload. So this right here is demand, this is demand, this is supply. Now, the market spends most of the time consolidating, trading sideways. So when you're in that accumulation distribution phase, it's very important. You don't want to trade while it's in this range. That's useless. If you're trading options, your theta is going to burn because when it's in this range, all it's going to do is trade sideways. It's clearly shown here. Okay. What you want to do is trade when it breaks the range. That's where the money is made, when the range is broken. Make sense, everyone? As you can see here, every time we break these ranges, it comes with a big push. Whether it's down or up, when you break the ranges, it's with a big push. You see it right here. You see how the price just violently breaks the range, comes back up, comes back down right there. See, breaks the range, strong candles. You see it? You're seeing it right here. When you break these ranges, it's going to be with a big move. Why? Because again, you have to understand what's at play here. You have both buyers and sellers, an equal amount. Whoever has the most power and whoever gets exhausted first, right? That's what the market does. If the bulls get exhausted first, that means the bears have all the power and the price is going to break the range to the downside and vice versa. So how do you play supply and demand? Now, supply and demand, it's effective on the higher time frames because institutions are not paying attention to the 2-minute chart. They're looking for those big areas on the higher time frames where they can place their orders, and that's where you really see supply and demand come into play. So let's look at this SPX chart, right? let's look at this. We're going to ignore this movement from the past week, and we're going to go back to this range right here, because again, this is where the accumulation distribution was at play. So what's the first thing we see? Obviously, we see a range. Where do we see the price continuously bounce the most? And where do we get the most consolidation? You see right there, consolidation, right here, consolidation, consolidation. So we know that this is the demand area right there, right? Because that's where a lot of the consolidation is at. So that's demand. Where's supply? Well, let's look to the upside. You see how the price that likes to consolidate up here around 4150? Okay, that tells us that that's where the supply is at. Again, they're keeping it back and forth between these two ranges because they're trying to accumulate and distribute, right? So you can see this better on the higher time frames right there. See it. So we know for a fact that as the price comes into this range, there's going to be a pushback. And as it comes into this range, there's going to potentially be a bounce. So when we come down to the lower time frames at the 15-minute chart, and we find our support and resistance area, so let's say that we're looking for a support and resistance, okay? Where do we have support? Well, clearly we have support around this 4110 level, right? You see how the price bounces there several times? Okay, so that's where we're gonna market support, 4110. Perfect. Now, here's the good thing. This is why supply and demand is good and how you can use it. As you break this support at 4110 and you're thinking about going short, you have to consider the fact that you're coming into a range that will potentially push the price up. You don't want to go short at the break of this support. Why? Well, because you have demand below. This will help you stay away from trades that could potentially harm you. Because if you short it there, because it broke a support level, right? You were probably going to be faced soon with a bunch of buyers, so we're going to immediately push the price back up, making your put absolutely worthless. So this is how you can use supply and demand to your advantage. If you wanted to go short, you have to wait for the support to be broken and to either see weakness in this demand zone or just completely break the demand zone. You do that, you can go short. But as long as you're still in the demand zone, just because you broke a support doesn't mean you go ahead and take shorts. Let's look to the upside. What do we have here? Well, obviously we can tell that there is some resistance around this range, right? Right around 4155 or so, that's going to be some resistance. You see how we touch it several times, unable to break it. All right, that's where we have resistance. Perfect. Let's look at this as an example. You break over resistance. Are you going to immediately go long? No, because you're still in a supply zone, right? What are you going to do? And this just helps you get better trades. It improves the probability of your trade going in your favor. That's what it's for. As you break over this, you start to check off some things. Trend, bullish, got it. Retest, got it. All right. Bullish structure, yeah, look at that. That's pretty bullish to me. You got a consolidation, you're breaking. You can see that there's a trend line resistance. You broke that, okay. Strong momentum, bullish. What's left? Well, the supply zone. You want to break the supply zone. You break over that supply zone, that's a good trade right there. Boom, you break over, you go from 4176 all the way up to 4214. That's a high probability trade, right? Let's look at the opposite, right? You're now above the supply zone, so it becomes a demand zone. As you break down from it, you start to use the same thought process. Okay, well, this is where we have our support. We broke below it, right? You're below it. Retest, retest. Trend, still bullish, but okay, let's say you want to take it because you're a bit stubborn. All right, What's the structure? Well, that looks like a double top. That's a bear flag, so bearish. All right. What do you have to do now? Well, you have to wait to break under the range. You break under the range like you did right here. Bam. Okay, good opportunity for shorts. You come down. And you use the same process over and over again, and you end up with a lot of good winning trades, right? Trading is about probability. And the more things that you're using that can help you verify that this break is valid, the better the odds of you actually making money on that trade. That everyone keeping up, that makes sense? You want to make sure that a lot of things are lining up together and telling you, hey, this is going to be a good trade. And all these things, the trend, the structure, right? The retests, the breakover supply, the breakover resistance, that's all things that are stacking up, telling you this long trade is good. High probability of it making you money. That's what you want to look for. And as you can see, you don't need a bunch of indicators on your chart. You don't need all this thing, ball in your pants, blah, blah, blah. No, you don't need any of this. All you have to do is verify that the price action and the movement is all in your favor. If it's in your favor, go for it. Because it's a high probability trade. Right? You don't want to just sell at supply because it's supply. No, you want to wait. Is there weakness at supply? Have we been rejected a resistance? Is the structure bearish? If these things are not all saying yes, then there's no reason to just short because you're at supply. Because supply could easily become demand if there's enough people behind the move and there's more buyers than sellers. And you also want to wait for consolidations. I'm telling you, the market spends most of its time consolidating. The best trades come after a consolidation. If you're patient enough to wait for a consolidation, you can get absolutely amazing trades. But you have to wait for those consolidations. And those consolidations will create the supply and demand ranges that you can later use to say, hey, we're over this, structure's in my favor, trend is in my favor, we got a retest, let's go for it. Good trade. All of a sudden, boom, you're up 100%, and you're sending me a good message, you're sending me a very nice message saying, thank you, you've taught me a lot. Now, the last one. It's one that most people don't fully understand. It's liquidity. What is liquidity? Liquidity is simple. Liquidity can be explained by, it's the trap of retail. Liquidity, contrary to supply and demand, where there are orders from, either just retail traders and institutions that want to go on a specific side of the market. Liquidity is where the stops are at. Let's say you buy Tesla at $250 and you have a stop at $249, right? And because you think that 249 is a support point, that's why you place your stop there, correct? All right, well, there are thousands of people thinking like you. So they're all gonna place their stops at $249. Now, me as an institution, I think Tesla will go higher, but I'm gonna place such a large order that I don't think there are enough sellers in the market for my order to get filled. So what do I have to do? I have to create the sellers. How do I create the sellers? Simple. I trigger the stop losses of all the longs, which is going to cause them to sell, and I'm going to use those shares that they're selling to go long. So when I do that, in order to do that, I have to know where those stops are at, where the liquidity is at. And it's very predictable. Figuring out where the liquidity in the market is very predictable because it's just stupid how people, the mass traders, figure out where to place their stops or where to get out of a trade. Let's go through this. So again, liquidity is stops. It's mainly made out of stop losses. And those stop ranges are the entries for institutions, whether it's long or short. So the first thing you have to do to figure out where liquidity is you have to think, where are the most trapped buyers or sellers? if you look at Tesla right here, right, we have a beautiful move up after hours on news. Right after that move up, right, we get this red candle. After that red candle, we get this candle with a very large wick. So in theory, we can say, you know, this move down caused anybody who bought in this red candle to now be at a loss. And with this move down, you also know for a fact that a lot of people who bought there are going to have their stops somewhere around this range as well. So this candle, the easiest way to explain it is the last candle before a swing low or a swing high is the candle that holds the liquidity. So this candle right here becomes the liquidity, but not really the entire candle, just the body of the candle. So what I do is I come and I mark the entire body of the candle, right? And I just push it up. And would you look at that? Isn't that beautiful, folks? The body of this candle became the liquidity area for Friday. You see that? You're all seeing that? Isn't that beautiful? See how that first candle in the morning came down, exactly bounced right there, where the body of the candle started. That's the liquidity. And throughout the day, the goal of the institutions is to bring the price down to liquidity hunt everybody here. They're going to stop everyone, every single long out. That's the goal, especially after a big move. If the price has a big move, you have to look for the liquidity zones to the downside, because the market makers that didn't get in, they don't want to get in at $250. They want to get in at a cheaper price, and they're going to do that by bringing the price down. This is the magnet that attracts the market the entire day. And the moment it comes into there, you're going to look for signs of a reversal. The biggest tell is a reversal candle. This is your typical reversal candle right there. So when I see this candle, after coming to a liquidity zone, I immediately know that the price has a very high chance of going higher. And when you look at that, bam, price just goes higher immediately, right? See that? Let's look up here to the upside. Where do we have some liquidity? Well, the first thing we have to do is figure out what was the last candle before a downturn. Well, you see how this red candle started the downturn that took us to 2:45 in the morning. So that means that this green candle right here, this is where the liquidity is to the upside, right there. And when you look at that again, look at the resistance. You seeing that? Everyone's seeing that? The body of this candle was exactly the resistance that we had early in the morning and then later in the day. That's where the liquidity was built to the upside. What did they do? They moved the price up because they know that some people went short around this area and had their stop losses up here. So they came up, liquidity hunted you, got your reversal candle, bam, down we go to where we really want the money. So the way to play liquidity is really simple. First, I have to identify where is the most liquidity and what was the biggest move we've had recently. If you had a big move to the downside, liquidity is going to be up. If you had a big move to the upside, liquidity is going to be down. And the entire day, they're only going to focus on attempting to bring the price down so they can grab the liquidity and stop hunt all the people down here, which is exactly what they did towards the end of the day. And that would have been a great opportunity to go long at 244. The price went all the way to 248. Right? And as you know, to the upside, yes, we have liquidity here. All right, moved up, reversal candle, moved down. And then you see we retested that, breakdown, retest it, down we go. You can see this across the board. You know, if we go back to SPY, we're on SPY. All right, let's see SPY. Let's look at after hours, right? Or just throughout the day, really. All right, right here, bam, 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 price moves up, price moves down, price moves up. All right, you see that right there? Previously, price moved down, price moved up. But if you look carefully right here, you see how right before the end of the day, you had this candle, reversal candle, and then when the price opened, it moved down. So obviously, this becomes a liquidity zone right there. As anybody who went long here, by the time the market opened, was at a loss, they probably sold off, right? So we can mark this as liquidity right there. Bam, you see where the market bounced? And also, if you pay attention, you see that right there, this candle, right before this big one that had a large wick to the downside, and this is where we bounced. Bam, this is your liquidity zone. This is where the market wants to hunt. And you can even expand it more, because if you look, it's really about a range, this candle right there, move down. So, you know, you can play around with it, try to find a specific range for liquidity, but usually it's going to be the body of the last candle before it moved down. But if you play with it, you'll see it just for yourself. But anyways, this was really the liquidity zone on Friday. And the market moved up. And if you remember, I was short early morning because I knew for a fact that at some point throughout the day, they had to come back down and retest liquidity, because they weren't just going to let the market pop. A lot of these institutions cannot trade pre-market. So they missed out on this move. How were they going to get back? Well, they wanted to bring the price down. You guys remember, I was short on Friday, early morning. I was short because I knew the price was going to come down. Now, I didn't trust myself. I knew I had a stop loss at 432.20. I got out earlier, so on. People were complaining and blah, blah, blah. I got out, but ultimately I ended up being right. Market came down exactly to the liquidity area to grab all of that money and stop all these people. Because as somebody, you know, a retail trader starts to trade around 8 a.m., right? Around 8 a.m., what do we have? The price is all the way over here. You FOMO'd in. What do? Oh, look, we have some support right here. Let me place my stop loss around this area. Very predictable, right? Most people place their stop losses right around 429 because it's also an easy number, you know, 429, easy number, goes back to what I was saying earlier about the support and resistance. You're looking for those even numbers because they're easy to remember for retail and algorithms love them. Easy number, 429. Now the market makers knew where to take the price. They wanted to take the price under 429 to stop people out. They did that, bam, there's your reversal candle, longs in play. Market moves up. You see? Pretty, when you really look at it, you'll see how it all makes sense. And, you know, you see this candle right there, this big yellow candle, big green candle was the last candle before it moved down. That's also liquidity. But really, you know, after hours, this is what they really wanted because it's where most people that. But even if you do this candle in itself, you can still see that this was the exact range they wanted to target because they want liquidity. So when you're looking to enter a trade, you have to know, okay, is there liquidity here that they may be targeting? If the answer is yes, that's probably a fake out. All they're probably doing is trying to grab liquidity, and you don't want to take that break because it's just a liquidity grab. It's a fake out. It's not going to go up. It's going to go down. Exactly what they did right here, right? You know, break 430, beautiful, fake out, bring it back down, slam it. They did two things. For one, they trapped a lot of people up here. So now they know that there's a lot of short sellers trapped up here with stop losses near 432. And they know that there's a lot of longs that when the price moves back up, they're going to sell. Right? So what are they going to do? They're going to wait. And then early morning on Monday or tomorrow, what they're going to do is they're going to try to move it up, top all those stop losses, bring it down, trap more people with options, pop it up again. When you really look at all these things, you will see it so clearly. And if you really go back, you know, again, higher time frame, supply and demand, that's what really matters. Look at this. If you look, if you paid attention, what do we have here? Well, look at that. Isn't that funny? Look at this. You see that right there? That is a supply zone. Why? See how the price like to consolidate here, trade sideways. You see that bounce a little bit. You bring that over. Bam. There you go. Go into the 5-minute chart, whatever you use. Everything on Friday was pointing to a move down. We were at supply. They were grabbing liquidity. There was a resistance. Look at the resistance clearly. Go back up. If you look right there, bam. You have a resistance very clear right there. Come back to your 15-minute chart, 5-minute, whatever you use. You see? You see how you didn't get a retest of the resistance, right? Then you broke down, you did get the retest, but to the downside, right? That's a rejection right there. You got your rejection. There's liquidity they wanted to grab to the downside, so the price had to move down. You're at a supply zone. Everything on Friday was saying short. Went short, fucked up a little bit, but my idea was right. I knew the price had to move down. It had to, because everything was pointing to sell-off. Okay? Oh, man. Oh, any questions, folks? And when it comes to playing my levels, I like to play them on the 2-minute chart, the pre-market notes. I like to wait for just a close over because I'm very confident in my levels. I personally am. You trade them however you want to. They're very good. I can sit here and show you how they all performed Friday because they were absolutely amazing. So you need to pay attention to those levels, right? You want to use them to kind of understand where there could be resistance, you know, because my levels are a mix of certain things. But you want to look for those, you want to pay attention to those levels. Maybe I missed it. What time frame do you liquidity? I like to do it on any time frame really, but liquidity is very effective on the lower time frames as well. For confirmation of a rejection at supplier demand, do you wait? You don't have to wait for the 15-minute candle for confirmation. See, let me tell you a little secret about confirmation. People think confirmation is a rejection. No, confirmation is shown before a rejection by the price getting weaker, seeing bearish formation such as some inverted, an inverted head and shoulders, a bear flag, right? A rising wedge. All these things are visible before the price even rejects a level. So the confirmation really comes again. Trend, the trend is the most important one. Structure of the markets before the touch of the level. And if it breaks or if it rejects, does it get a retest? Look at this right here, right? Price broke up, immediately rejected, got a retest, right? In this case, you knew the market is very overbought, very big push, has to come down. There has to be a pullback. You know, there's liquidity to the downside. You know, you're in a supply zone. So the weakness that the market was showing here was the key to know that if it wasn't able to break out the second time, this was just a retest and we were moving down. So the confirmation is just the way that the price is moving and what is the market doing. That's your confirmation. What is your average stop loss for SPX? I don't know. I don't have an average stop loss. Whatever my strategy says the stop loss needs to be. My stop loss is when my trade is no longer valid. That can happen at any point. If the reason that I entered is no longer valid, that's when I get out. Any questions? I have about 10 minutes. I will be sending the class out shortly after it's done uploading. There is no stop loss. I get out when the trade is no longer valid. When you trade, do you look at all time frames or stick to a particular time frame? I like to use the 3 minutes, but I short on any time frame. Could you explain more how to find liquidity? I can't go too much in depth. That's for another time. I just gave you the biggest secret to finding liquidity. The last candle before there was a swing high or a swing low. And it's usually going to be a red candle a green candle when there's a swing low and a red candle when there's a swing high. Do you use volume to determining it? No, volume is absolutely useless. There's no benefit from volume whatsoever. At least in my experience trading, everyone's different. Everyone has their own thing. How to trade if a trade is invalidated? It's simple. Why did you enter the trade? Once you know why you entered the trade, then if that's no longer valid, that's when the trade is invalidated. Guy, I appreciate it. We'll be doing more classes for sure. At least once a month, I can promise you that. Correct, because consolidation is shown mainly by small consolidations in price at a specific range. Can you talk about the fake out scenario? Fake out scenario is a liquidity grab. It's that simple. A fake out is usually found by a move opposite to the trend. Okay. The trend is up. Most moves to the downside would just be fake outs. So if there's liquidity to the downside, that's when you say, okay, well, there's liquidity here. We're breaking. That doesn't mean the price is reversing. It's a fake out. Yes, you will get a copy of the recording. I've been asked this 555 times. I will send the recording today as soon as it's done uploading when I'm done here. Rocky, my pleasure. That's what I try to do. Simplify things. If you've taken my classes any times, you know that I try to make it as simple as possible because there's no benefit from complicated stuff, especially when it comes to trading. The simpler, the better. I'm very lazy, so I like to make things easy to understand. Brain of a 5-year-old, so I got to make it easy. Otherwise, I'll just end up going nuts. Where do you draw your levels? I can't tell you that right now, my friend. There's going to be a training camp for that really soon. A boot camp. 4 weeks of just classes every day, live trading using the strategies. That's coming. That's coming in August. For trend definition, do you use, I like to use the 4-hour for the trend. 4 hours is probably the best one. Are there any good indicators for supply and demands? There actually is. It's called easy layup. It's my algo, man. Easy layup. Supply and demand zones. Is that it? I always get confused because I think that there's, no, it's the newer version. Can anybody help me that uses easy? Which one has like the supply and demand? Is it this one? I don't think it's this one. I think it's this one right here. Is it? Let's see. Come on, bro. Show up on the chart. What the fuck is? Oh, yeah, it's this one right here. See, you got your supply and demand lines drawn for you. Oh, it's the smart money concepts one. Hold up. Let me find that. I'm sorry. I forgot we had that. So they have the box. Fuck me, bro. I don't know. It's probably version 2.0, right? Is it version 2.0? Yeah, no. Damn it. Fuck, this is why I need JT here. God's sakes. Fuck me. Where is it? Oh, here it is. My bad. There. Is that? Better be that. I'm gonna be pissed. There it is. Yeah, that's it. Bam. When do you decide to take SPX because of it all depends on how I'm feeling at the time, man. If I feel really good, I'll take SPX. If I'm just feeling okay or just good, I'll take SPY. It's the same thing. It's no different. Who wrote easy layup? Well, if you're gonna praise, if you're gonna say that it's good, I did it. If you're gonna complain about it, some other person, I think JT did. But it all depends why you're asking the question. Any other questions? 4 minutes. I will be live tomorrow in the afternoon, not in the morning. Yeah, JG is not here. It's amazing. Yeah, man, I wrote it. Of course it's amazing. But you know what's even better? You want to know what's even better? Oh, my box, man. My box is beautiful. My box is the best thing that has ever happened to mankind. Obviously, behind sliced bread. But when it comes to trading, the box is the best. I will take full credit for the box. And I will not tolerate any box slander. What is box? The box is this right here. It's an innovative product that has changed trading for me and everyone else that has ever used a box. It's this thing right here. It's the best invention. It tells you whether the EMAs are bearish, if VWAP is bearish, if the long-term and short-term trend is bearish or bullish, and if the TTM is bearish. It's basically giving you all the information from indicators without having to have the indicators in the chart. It helps you clear up the chart and just get the information straight up. So you don't have to know, you don't have to guess, is the MACD bearish or bullish, have it all in the chart. It's just there. D-Dom, my pleasure, brother. Thank you, Tamika. Thank you, Clifton. Well, folks, love you all. I will see you tomorrow at 1 p.m. for some live trading. If you have any questions, send me the DMs. And if you're interested in working for me as my live stream moderators to kick out the clowns, send me a message. I need somebody ASAP. Have a beautiful night, and let's get ready for tomorrow.